Healthy banks, financially strong households, and attractive rates contributed to a surge in the use of credit in 2022. But can a hawkish Fed get borrowing under control, or will it lead to higher inflation down the road? We're here to discuss this. Fed guy, blogger, and monetary macro CIO, Joseph Wang. So good to see you, Joseph. So what are your thoughts on this, on how much this is going to end up fueling inflation?
Hi, Rochelle. Thanks for inviting me. And you make a really good point. We're having a tremendous credit boom here in the banking sector. So just for some context, usually the banking sector creates about $400 billion of loans a year. But last year, the banking sector created $1.2 trillion worth of loans. So there's a tremendous credit boom happening. So what that means is that the households, the economy has more money to spend, and that means more demand. And like you suggested, that is helping to fuel inflation. If you think back about what happened last year, prices are going higher everywhere. And part of the reason for that is because people have money to spend. And that's because banks are creating money. Now, the question is whether or not the Fed, by hiking interest rates aggressively, will be able to tamp down on that bank credit creation. Now, that's a really hard question to answer. Now, you'd think that with higher interest rates, there'd be less credit creation. But the funny thing is, when you actually look at the data, credit creation has been pretty strong all throughout last year. Now, it's slowed down a little bit, but it's been pretty strong. And that stands in stark contrast to what we've been seeing for the past 10 years. I think it's worth noting that when you're thinking about credit creation, it's really not just about interest rates, but there are other factors as well. For example, the willingness of banks to lend and the willingness and capacity for borrowers to borrow. Now, we're in a very different context now compared to, say, right after the great financial crisis. Our households, extremely strong. Balance sheets, net worth, among the highest ever. Job market is strong. Banks are healthy. So there's a lot of willingness and capability to lend. So I'm not sure that rates where they are right now is going to be able to slow the economy, slow the banking sector down sufficiently to get where the Fed wants it to be. So that's something we're going to figure out in the coming months.
I mean, as we start to look at some of the cracks, I mean, take, for example, Wells Fargo, which, you know, the number one player in mortgage is starting to now pull back from that. What should we read into that as we look at sort of at the tea leaves as to what that might mean going forward and how banks might start acting this year?
Yeah, so Wells Fargo's, well, it's hard to look at just one individual bank to generalize the story. As we know, Wells Fargo's has been in some turmoil over the past few years. When you're talking about mortgage lending specifically, though, I think it's important to bear in mind that only about half the mortgages are made by banks. There's been a huge change in the mortgage industries in the last 10 years. Most mortgages are actually made by non-bank lenders now. So if you zoom out, though, just look beyond mortgages, you have C&I loans, commercial loans, you have commercial real estate loans, you have, let's say, credit cards and things like that. That's all growing. So I would expect some slowing in residential mortgages, although that's not really apparent in the data yet in terms of quantities. But there are other credit areas that continue to grow strongly.
And which are the ones that you're seeing that are growing strongly?
All of them, actually. So if you break down so the Fed has weekly bank data, and it breaks it down. It's very timely, so it's every week, and it breaks it down by different categories. And all categories of loans continue to grow. Now, they've moderated slightly over the past month, but they still continue to grow at rates that are above what you would expect before 2020. So before 2020, you'd say maybe loans would grow at an annual rate about 5 or 6%. They're still growing at about 9% annual rates these days. So, and that's after all the rate hikes we've seen so far. So the rate hikes are working a little, but probably not to the extent that the Fed needs it to slow down to.
And as you mentioned, if households are still strong, although we have seen more households sort of dipping into their savings for some of these essentials, how do you break this cycle then if this is fueling inflation and it doesn't seem to be working in that regard?
That's a hard question. So from the Fed's perspective, I'm thinking that they would just kind of continue to do what they're doing. Well, the thing is that that's the only tool they have to raise interest rates and try to slow down credit creation. Now, it is working. It's just not working as effectively as I think people would expect. I mean, rates are maybe going to be 5% by the middle of this year. But again, that's not the only thing that matters. If you're a borrower, you have to take into account a lot of other factors as well. If you look at the labor market, for example, wages are growing strongly, unemployment is low, if people have confidence that they can keep their job and they'll have healthy wage gains, maybe those interest rates are not as scary as it might be in a context where labor market is weaker. And by the same token, if you're a bank looking to lend at someone, you see people, households having strong wage gains. You see them having a lot of equity in their homes, maybe fatter 401k portfolios, not as fat as it was earlier last year, but still comfortably above the pre-COVID levels. You might be more willing to lend to them as well.
Indeed, we'll be keeping an eye on that, especially as we sort of track what we see with potential recession fears as well. Fed Guy blogger and monetary macro CIO Joseph Wang, thank you so much for joining us this morning.